Recently started working with a business owner. They had been in business over 20 years. Revenue was closing in on 8 figures a year. But guess how much they had saved up outside of their business? Less than $150,000. And that might sound shocking to you, but unfortunately, that's not a rare story. It's the most common one I see. Today, I'm going to show you how to not end up as a broke business owner and cut your tax bill at the same time. I'm Daniel, and I help business owners stop overpaying the IRS every year, keep more of their profits, and finally start building real wealth. In this video, I'll show you how to cut your tax bill and build real wealth outside your business all at the same time. Specifically, how a 401k gives you a tax deduction on both your taxes, business, and personal. Why it's the most powerful retirement tool a business owner with employees has access to, and why the timing of when you set this up matters more than most people realize. As a business owner, you've built something real, a business with real revenue, real employees, and a reputation you've earned over years of hard work. That's no small feat. That's everything. And you should be proud of that. Let's think of that like a house. But here's what happens to almost every business owner who puts their head down and works. The years stack up, and while you're focused on payroll, client, and keeping the operation moving, two things are happening quietly in the background. You're missing years of building wealth that exists outside your business. Wealth that no slow quarter, no difficult client, and no unexpected expense can touch. And every one of those years, you're writing a bigger check to the IRS than you have to. Think of it like this. The business, that's the house you've been building. Genuinely valuable, but the land, everything around it, it's the wealth. The wealth that's yours no matter what happened to the house, that's been sitting empty. A 401k is how you start filling it. And done right, it cuts your tax bill every single year you do it. So let's get into how this actually works. Here's the number that stopped me when I first saw it. More than half of small business owners have no retirement at all. Zero. Nothing set outside the business. And for ones who have something saved, business owners between the age of 45 and 55 years old, the most common balance is about $50,000. Think about that. Only $50,000. How far would that get you without the business? There are people running real businesses, earning real income, and $50,000 is all they have to show for it. So what's the gap? Generally, it's not income. Sometimes it's discipline. But it's also that nobody has built a system for it. The business demands everything, and personal wealth building gets pushed to later date, and later keeps moving farther and farther away. That's what we're going to fix today. And the tool we're using does two things at once: builds the wealth and lowers your tax bill. It'll show you exactly how this works in a few minutes. Here's the assumption most business owners have. Usually they're not saying it out loud. They say something like, someday I'm going to sell this business, and that will be what funds my retirement. It'll all work out. Maybe it will, but having worked with business owners going through the sale process, that plan has a lot of ways to fail that most business owners haven't thought through. Most small businesses are not easily sellable, not because they aren't valuable, but because they're built around the owner. You're the relationships, you're the reputation, you're the reasons clients stay. Remove you from the equation, and a buyer has to ask, what exactly am I buying here? A lot of businesses never sell at all. They just wind down. The owner walks away with less than expected and more regret than anticipated, or they just keep working well into their older age. I see this pattern regularly. The business owner closest to retirement are almost always the ones most surprised by how little they have outside of it. They spent decades building something valuable, but never set up the time to build something outside of their business that they can rely on. The 401k isn't just a retirement account. It's the backup plan that becomes the real plan. Wealth that's yours regardless of what happens to the business, and there's no buyer required. If you're watching this and thinking, that sounds a lot like my situation, or something you want to avoid, you're not alone. This is exactly the conversation I have with business owners every week. There's a straightforward path forward, and it starts with understanding how this tool actually works. Most business owners think of a 401k as something you offer employees, a benefit, a line item on the budget, a retention tool, something the big companies or corporations do. But here's the reframe. A 401k is the most powerful tool you have to take a profitable business and turn it into real personal wealth and reduce your taxes. for you first and for your team as a bonus. Here's how it works. A 401k has two contribution buckets. The first is the employee deferral. This is a contribution as an employee of your own business. In 2026, you can put up to $24,500. If you're 50 or older, you can add an additional $8,000 on top of that. The second is the employer profit sharing contribution. This is your business contributing on your behalf, up to 25% of your compensation. Combined with the employee deferral, that total you can put away in 2026 is $72,000. That's a significant amount of money moving out of the business and into something that belongs to you. Now, inside the 401k, you have a choice, traditional or Roth. Traditional contributions lower your taxable income now. Roth contributions go in after tax and can come out tax-free if qualified. Which one makes sense depends on where you are today versus where you expect to be in retirement. That's a planning conversation worth having, and we'll touch on that more in a minute. One more thing worth mentioning. When you offer a 401k to your employees, you give them a real reason to stay. 3/4 of employees say a retirement plan is a must-have benefit. A well-designed plan with a vesting schedule gives your team a financial reason to stick around, and that's something you control. Now, there's a tax benefit when it comes to this that almost nobody's talking about. This is the part most 401k conversations skip entirely, and it's the part that should get every business owner's attention. The 401k doesn't just build retirement savings, it cuts into your tax bill, which we all like. And that's on both sides, the business and the personal. Here's what I mean. Your employee deferral, that contribution you make as an employee of your own business, reduces your personal income tax. Put in, let's just say the $24,500. That's $24,000 the IRS doesn't touch. Your employer profit sharing contribution, the contribution your business makes on your behalf, is deductible at the business level. That's a separate deduction running through a separate tax filing. One decision, two tax one, personal and business simultaneously. Now here's an example. Say you're an S-Corp owner paying yourself $150,000 in W-2 wages. You max out your employee deferral at $24,500. Your business makes a profit sharing contribution of, let's say, $37,500. That's 25% of your compensation. You've just moved $62,000 into a retirement account and reduce your taxable income by the same time across both filings, business and personal. Let's say at a combined federal and state rate, you're at 35%. That's roughly $21,700 back in your pocket this year alone. Now, every year you do this, think about how much that could add up over time. And here's the thing. Most business owners earning real money have been writing that $21,000 check to the IRS every single year. The tool was sitting there the whole time, but they had no one watching over and helping them maximize their tax benefit. One thing worth flagging before we move on, starting in 2026, if your W-2 wages were $150,000 or more in the prior year, your catch-up contribution must go in as a Roth 401k. If that applies to you and nobody has mentioned it, now you know. Now, as we've gone here through this small example, if you're realizing there's more planning here than your CPA has walked you through, that's not a knock on your CPA. Most CPAs are focused on filing their return accurately, and they do a great job. Proactive planning like this is coordinated your salary, your contributions, and your tax strategy before December. It's a whole different conversation. It's what I do with business owners year round. If you want to know what kind of planning there is, the link is in the description below. Let's talk about the contribution limits and the numbers so you know exactly what you're working with. In 2026, the total amount you can contribute to a 401k is $72,000. That's the employee deferral and the employer profit sharing contribution combined. If you're 50 or older, that's an additional $8,000 that you can put away. Now, if you already have a SEP IRA, and a lot of business owners do, a SEP only has one contribution bucket, the employer side. The 401k adds the employee deferral bucket on top of that. For most business owners at a meaningful income level, that's a significantly higher ceiling and a significantly larger tax deduction. Here's a quick comparison. A business owner paying themselves $100,000 in W-2 wages maxes out their SEP IRA around $25,000. That same owner with a 401k can contribute $25,000 on the employer side, and on the employee side, they can do $24,500. Nearly $50,000 total. Same income, same business, twice the contribution. That's not a small difference. That's decades of compounding on dollars that would have otherwise just gone to taxes. Here's where most business owners get caught, and it's a painful one because it's completely avoidable. The plan has to be established by December 31st to get the full benefit for the tax year. Both contribution buckets, the employee and the employer, require the plan to be in place before the year end. Wait until January and you've lost the employee deferral for that entire year. You can still make the employer profit sharing contribution up until your tax filing deadline, but the employee deferral bucket, that's closed. For someone maxing that out, that's $24,500 you can't get back. Here's why this keeps happening. Tax season, that's when most business owners think about this kind of stuff, because your CPA is filing your return in April and mentions you could use a retirement plan. So you put it on the list, and then the year gets busy, and suddenly it's February again. This is a decision that has to happen well before the end of the year, not in April. Here's something most business owners never hear. If you're setting up a new plan and have employees, you may qualify for some tax credits under Secure Act 2.0, spread over the first 3 years, to cover startup and administration costs. For a lot of small businesses, that makes the cost of getting started nearly zero. Your CPA isn't ignoring you. They're just not having the conversation at the right time. And that's the gap. Now, if you're ready to stop waiting and get this in place before year ends, reach out. The link to schedule a call is in the description below. We'll look at your numbers, figure out what makes sense for your business, and get the ball rolling. The sooner you start, the more you can save. Setting up the plan is step one, but a lot of business owners do that and then never think about it again until they're adding or removing an employee. That's leaving value on the table. A good 401k provider should be doing more than maintaining an account. They should be educating your employees on how the plan works, how to pick contributions amount, and how to think about saving for retirement. From my experience, your team isn't going to figure this out on their own. A provider who shows up through meetings, resources, or regular communications make the plan actually work for the people in it. One thing you control as the employer is the vesting schedule. That's how quickly your employer contribution becomes fully owned by the employee. A well-designed vesting schedule gives your team a concrete financial reason to stay. It's a retention tool built right into the plan, and most business owners never think to use it that way. The wrong one makes you feel like you're on an island. You need to know the difference before you sign up. Now, if you're watching this and thinking outside of just the 401k tax deduction, if you've ever wondered how much you're actually leaving on the table when it comes to taxes and overpaying the IRS, I've got something that can answer that in less than 90 seconds. It's called the Business Tax Efficiency Score. You answer a few quick questions about how your business is structured, how you're paying yourself, and what you have in place for retirement, and it shows you where the gaps are. It's 90 seconds or less. The link is in the description. Take time and find out where you stand, because the business owner who are paying the least in taxes aren't the ones who got lucky. They're the ones who found out where their gaps were and are closing them. If you want to learn more about tax deductions that most business owners are missing every single year, click right here. I've got a video for you to watch next.